This podcast is for professional investors only.
The pursuit of alternative alpha has been hailed as the next frontier in quant investing. Using artificial intelligence, algorithms, and vast volumes of new data types to explore untapped sources of returns does sound intriguing, especially when times are uncertain and alpha is elusive. But is this hype, false hope, or real opportunity? And what does it mean for investors? We're combining a quantitative and a fundamental perspective to answer these questions. So around the table with me, we have Wei Li Tsao. She's head of quant equity research at Robeco. Daniel Ernst, who's a senior investment analyst at Robeco with a speciality in global trends. And Mike Chen heads Robeco's alternative alpha research. Wonderful having you here in town with us and around the table. Welcome.
Thank you, Erica.
Thank you.
Thank you. Happy to be here.
Let's get started with these terms. These are really big names, big terms being thrown about. So what precisely is meant by AI, machine learning, and alternative data? Mike?
Yeah, so artificial intelligence, I think it's a term that's actually used quite a lot, but it is actually quite distinct from machine learning. And roughly speaking, what artificial intelligence is basically if you think of something as sentient, it can think for itself. It can actually have intuition and can infer from knowledge, from context, from its experience, and make judgment and decision on stuff it hasn't seen before. That's artificial intelligence. That's basically like human intelligence, right? What we're doing in finance, actually in general, is a subset of artificial intelligence. It's called machine learning. And machine learning, rather than being able to make inference from experience and make estimates or decisions about things it hasn't seen before, cannot do that. Machine learning is basically what it does at a very basic level is it maps inputs to outputs from results that it's seen before. Right, it can make linear mapping, but it can also make non-linear mapping. That's why it makes it so powerful. It can learn from vast amount of data, and it can appear like it's sentient, but it actually isn't. It has to see the data before it knows what to do with it. Right, if it hasn't seen it, it cannot make inferences or decisions.
And then what about alternative data, the unstructured data we keep hearing about?
Yeah, so if you think about it, traditionally in finance, right, historically the data has been very structured, very tabular. So these are data you get from market returns, you get from financial statements, right? These are data that can be fit in the table, really. But obviously we all know now that the world is awash in data, not just these very structured, relatively small, compact data. You have all sorts of information that's out there, right? So the internet is a huge source of data. Your GPS, right, where you go, it gives off geolocation data. Your cell phone, satellite images, your credit card spending, that's all data. Actually, what people say when in both textual and audio waveform, that's all data. And alternative data is really anything that's beyond the traditional financial statement and market return type of data. And us investors are trying to harness that vast amount of unstructured data into see if we can get further insights into our investment process and deliver alpha for our asset owners.
All right, so we're going to pick up on this and go far deeper. Daniel, it feels like a new paradigm that we're entering. What are you seeing as an analyst of global consumer trends?
Right, I think you already see AI, or rather machine learning, fitting into your everyday life. As Mike mentioned, your navigation system is routing the best way to get home without, to avoid traffic. When you open an email and it starts to autocomplete what you might, say in a response. You're seeing it in these sort of small ways, but we're also seeing it, I think, in bigger ways, right? People are looking at this for medical research, for drug discovery. But I would highlight kind of two trends that are kind of already here today that are actually monetizing. Or to put it the way Facebook's first CTO in 2011 put it, the brightest minds of my generation are attempting to help people click on ads. And so AI has become or machine learning is becoming kind of the tool of choice in sort of creating content or sort of filtering content in the way that you want to see it and then placing an ad in front of that. So there's a way that actually you're seeing advertising as a $500 billion business globally. And so you're actually seeing it there. TikTok's algorithm around how it's kind of eerily good at deciding what you might want to see next, but it also places an ad in that way. And then the other one you hear people talk about a lot is autonomous vehicles. But long before you get to autonomous vehicles, you actually can have these things notice that there's a car stopping in front of you and hit the brakes before you. And so while there's been some notable accidents with autonomous cars from Tesla and others, what the data shows is when those features are engaged, there are 90% less accidents. And then the other one where autonomous is actually not about vehicles, but it could be in controlling systems. So Google applied their DeepMind division to their data centers. And in that process, they discovered they could save 40% of their energy costs by altering the cooling systems in the data centers. And so you see it in these tiny, small ways in your email, and you're seeing it, in this, in the news on sort of autonomy cars. And then it's, helping to green the planet by, turning off the lights when you don't need them on.
So what I'm hearing from you, Daniel, is it's everywhere. It's also generating so much data for us to use, and it's also helping us in many ways. How is it helping us within asset management, and what's the objective, what's the purpose of machine learning and alternative data here?
Well, yeah, so in asset management, right, I mean, the goal is always the same, it's to deliver investment results and solutions for our clients, right? And I think alternative data, machine learning, alternative alpha just really opens a whole new frontier. Right. Again, traditionally, from a quantitative perspective, we've been limited to relatively small sets of data. Our tools have been relatively constrained as well. We're mostly limited to discovering linear relationships, right? But now with this vast amount of data and these powerful algorithms that can discover nonlinear, interactive relationships, and also how did people talk, right? Their sentiment, what they're inferring, are they actually being evasive when they answer questions? These give us, the capability to answer investment questions that were always interesting, but until until recently, we have no tools and data to answer and to test if our investment hypotheses are correct. So I think that just really opens up a whole new frontier of research for us investors.
Yeah, and I think what's adding here is the explosion of computational power we have seen in the last decades. Because machine learning, AI, that's not a new thing, right? So back in 1970s, 80s, actually, there have been machine learning models, but the use of cloud computing powers and all these, that brought the research and quant investing to a much higher level, that you can really dig much deeper to find meaningful relationship, nonlinear relationship, that you can put all those alternative huge data sets into your proposal and extract very important hidden information out of it. And I think never before I've seen financials and investment industry being so linked to technology nowadays. And this is also quite a change compared to 20 years ago, for example.
Right. So if I were to ask you why now, why is it now such a hot topic? I think you've answered the question. We've got the technological capability, and we have more data, but it does seem to have become a hot topic. So why such a hot topic right now? And just to give you some color for this question, here's a quote from Marcos Lopez de Prado. He's head of quantitative R&D at ADIA. He was speaking on the Parkview podcast.
Traditional data sets have very little alpha left. Why? Because they're relatively easy to model, they are accessible, they're standardized, and as a result, it is the trodden path. Everybody has access to them and can try and develop strategies. So the alpha, what I call macroscopic alpha, is extinguished, is gone. But microscopic alpha is more abundant than ever. Why? Because on one hand, you have data sets that were not available before and that are very difficult to manipulate. They are very difficult to model. So that gives you access to opportunities that were not accessible before. So that's on one hand. And on the other hand, you have the errors made in funds and the quants that still utilize the old techniques, and those errors can be exploited by machine learners. So as a result, microscopic alpha is more abundant than ever.
Any comments on that?
No, I think Marco is exactly right. I think part of the reason why it's been harder, the traditional factor, is because how successful us practitioners and academic has been, right, in explaining sources of return, right? So you think about Kaplan, you think about Pharma French, these factor investing type. They were major discoveries, but unfortunately they're relatively easy to replicate, right? It wasn't easy before it was discovered, but now since everybody knows it, it's easier to replicate. So then, so the question is what's next, right? And whether it's fundamental investing, whether it's quant investing, whether it's investing 200 years ago or investing today, one of the fundamental laws of investing is that if an idea is commoditized, if too many people invest in the same way, you can guarantee that there's no return, right? So since these more traditional factors, have been relatively well known now, right? So there is a very natural impetus for us in the investment industry, trying to see if we can be somewhat differentiated, trying to still seek alpha, which is always desirable, no matter what the economic or environmental or technological development is, right? But just happens so that because of the availability of data, because of the availability of advanced algorithm, coupled with easily accessible, massive computation power, we now have the capability to go for these microscopic alpha that Marco talked about.
And just to get some of these anxieties out of the way, does this mean a reduced role for humans? Daniel, starting with you.
Never say never. I think I might have a bit of a bias in answering that. And I think, but to sort of reference back what Mike said earlier about the AI or the ML needs to have been given the data first before it can learn the process. And so I think when you look at structural change, where maybe habits have changed, or maybe might call it who moved my cheese, right? Where the end goal has changed. So take the evolution of personal computers, going from mainframes to desktops to laptops. And so that evolution you could predict would be about smaller and cheaper. But 20 years on from when I think that process kind of stopped growing, the puck kind of shifted from the PC to the phone. And none of the major PC makers, none of the major phone makers, the time that iPhone and Android came out, were positioned for that market. And so the algorithm were trying to predict market shares or trends or forecasts for the PC industry would have predicted that smaller and cheaper device. They ended up becoming smaller, but actually more expensive, but done in a completely different paradigm. They weren't necessarily about work first, but then work became part of that process, and it really sort of changed the way people experience computers. For most people, particularly say in developing countries, their first and only computer is a mobile phone.
Yeah. Well, from the perspective of someone within the investment industry, you managing teams, you invest, you think in those terms. Where do humans fit into this story? So a quote from a BlackRock insight talking about machine learning, saying ultimately, it's an investment team's expertise and culture that translate the power of technology into a better investment outcome. So implying you definitely still need the people.
Yeah, absolutely. We do not see that, at least at this moment, we do not see that machine replacing people. But we think machine, they're very powerful enabler, let's say, that make our work even more efficient, more productive, and more meaningful. And I would say that's at Robeco Quant, we definitely see that humans staying at the driver's seat. But the pre-processed information, for example, by algorithm, by machine, that could readily serve us as high-quality input. And also the role it plays in the production, for example, making sure that every quant enhancement or change of the algorithm is traceable, and it also the impact is measurable, and it's also adaptive over time by learning from the market, like Mike said, from seeing the data and the market and adaptive accordingly. I think from that end, we see definitely a huge role of a machine helping us, facilitating us, and make our work better.
So take us into your rooms where you work and where you think at your desks. What is Robeco's approach here to machine learning, to alternative data? What are you up to?
Well, I think for alternative data, we are skeptically optimistic. Let's say there's so many offerings outside on the street, and nowadays we're talking about 2,000 vendors, and everybody's trying to sell a very specific niche information to us. It could be satellite pictures of the parking lot, could be very specific industry in the local Chinese or Japanese markets. So it is, how I would say, an abundant choices out there. And I would say as a company, we have limited resource, we have limited hands. So we have to do the pre-screening and think very carefully what's the criteria we want to adhere to while making the choice. And also making the choice on starting something, not only on acceptance end, but also on starting a project in the first place. So I would say that we would first of all stick to economic rationale. I think that's also the place where we profit so much from a firm being strong both in quant and fundamental. Like, for example, if we see some credit data information, or if we see something very specifically related to a sector, for example, healthcare, I think we have so many expertise, fundamental analysts, colleagues to approach and say that, hey, do you think this data set makes sense? Would you as a human, right, make use of it in the first place? And that sanity check for us, I think, is crucial in already filtering out maybe 50% of the vendors that just brag about their quality and uniqueness. And once we start to research on alternative data, for example, we also have a couple of rules. First of all, the permanency risk. Would the data still be there after a year? Is it legal, for example, to scrape in this country? Would this data provider still be around in 2 years' time? I think this is crucial because financial statement, any report, that's something coming up every year, every quarter. But alternative data, there's no guarantee. And to make sure that your investment process is sustainable and also repeatable, such due diligence check is very important. And then, of course, we need to see, hey, what's the economic background and the rationale? That's what I just mentioned. But also the additivity to the existing signals. Because it can be that, it showed great backtest alpha, but at the end of the day, everything got explained away by existing variables or signals. Then you have to think, hey, does it really worth to spend this 50 grand on this data that actually for which the information I could get from existing variables? At the end of the day, I would say also a lot of alternative information, they are short-lived by nature. That's information advantage you get. So you just know 1 week or 1 month earlier than the other market participants. But if you take trading costs into account, if that triggers a lot of extra turnover, would it still be able to create net alpha for the assets that we manage? Is it better off in terms of the alpha and cost trade-off? So that's also where we look at as a criteria to access the value added from alternative data.
So what exactly is the plan? So you're speaking at length about alternative data, the practical, ethical, commercial aspects of that. But what then is your plan? Is your plan to take your quant approaches and enhance that or combine that with machine learning? Or are you cross-pollinating with the fundamentals team or just having a standalone commercial strategy based on ML and alternative data?
Yeah, so I think as researcher, right, we're basically just fundamentally interested in discovering new things, right? And one of the coolest thing about this job is figuring out how to dissect or predict the market better than, at least compared to yourself, a year ago, a month ago. So alternative data, machine learning, natural language processing, just give us that capability, right? Like I said earlier, it allows us to answer questions that we might have always had, but had no way to answer, right? So I think that is really exciting, actually. Like, for example, one of the things that if you work for a while, you would know that corporate culture is very important. BlackRock mentioned that, even though it's quant, it's about people, it's about culture. Culture is really important. And how do you measure culture, though? It is so intangible. It's so vague. It's so nebulous, right? How do you measure it? Well, now, with textual data, you can say, well, perhaps, we can see what kind of cultural traits, people, when they talk about a given company, they emphasize, right? So if they emphasize this, especially if they're senior leaders, and say, well, I know that culture guardians in a given company are mostly senior leaders, right? If they emphasize certain cultural trait, maybe the organization also reflects it. So that gives you a way to answer this question, perhaps not fully, perhaps not correctly or completely, but it allows you to get some handle on this very important but difficult to answer question. So I think that in and of itself is very exciting. So as researchers, we build these, in Quant, you build these signals or factors that can, answer or at least approximate these important questions you want to measure. And then, when you have enough these components, then you can build cool products, right? You can build them into either enhancing the existing product. As you know, a lot of the alternative alpha are quite complementary to existing factor type of more traditional factors. And actually, one thing I want to say is that alternative factors or alternative alpha-based factors do not replace traditional factors. They are actually complements. There's a study actually says about 2/3 of market cross-sectional variation, at least in equities, is explained by the more traditional factors, right? What we're looking for is how much of the remaining 1/3 can we gain insight into. So, so alternative alpha then can complement existing factor. Obviously, it can be packaged into its own product. But even for fundamental team, right? I think Wei Li would probably agree is that we can actually apply what we learn as quants and work with our fundamental colleagues in trying to make their process better. At the same time, we actually get to pick their brain because they're the real expert, the deep domain experts, right? Into understanding, what drives a specific group of stocks. These are the micro alpha that Marco talked about, right? So I think it's actually a very exciting time for both quant and fundamental investors.
Daniel, how far along are you as a fundamental team in incorporating these technologies?
I would say that it's quite early in the process. I think that we are positioned for long-term investing where the signals may not show up in the structured data, as I alluded to. And so, but I could foresee a process where, as Mike alluded to, where an AI or machine learning could facilitate tactical decisions. So as you're scaling up a new position or exiting a position, timing and trading and volumes, there's a part of that process which is a short-term in nature. And so there could be sort of like the before we get to self-driving car, you have, auto braking and, sort of where it's come up. And so that's sort of augmented, research where the AI could give you a signal before the car in front of you stops, if you will. But the other area I think where I think we'll see it, but building this software is relatively difficult, is the analog in enterprise software, something called robotic process automation. And that really is sort of like the autocomplete in the email. And so if you could have a machine learning sort of understand the process, sort of copy our process, there's a lot of manual things. We're reading transcripts, we're looking at earnings statements, we're looking at earnings revisions, and assembling all that data in a way that we could understand it better without spending all the time collecting all these varied sources, 30, 50 different brokers, different data sources, industry data, government data, company reports. Putting that together could actually save us a lot of time.
Now, it's clear from what you've all described is that this is indeed a very complex new field. What does it take for you as an asset manager, as an investor? What infrastructure do you need to be able to do this right? I'm
super happy you are asking this question because you are asking a system question, right? Mm-hmm. This is typically not visible to the outside world. People talk about models and the portfolio, but system...
It's abstract, right?
Exactly. Mm-hmm. And this is just how I say below the water, but it's so determinant. It's determining your capability of whether you can breed the next generation quants in the coming 10 years. And this is also the field for which we have invested very heavily in the past 3 years. So, for example, we're now operating on the infra platform that is so well connected to, for example, cloud computation, so well connected to different data scout centers for alternative ideas. And also very well connected to AI algorithm from different tech firms. So for example, the latest discussion we had is to look into the Google algorithm and to see how it can be applied to our NLP analysis. And also it's very much connected to the open source comprehensive machine learning training platform. So all these actually is very much powerful. And with these infra development in place, I think we're so equipped to, on the one hand, push for the new frontier of factor investing, incorporating all the new techniques. On the other hand, to explore for alternative alpha and bring new standalone strategies to the offering of the whole Quant house.
Yeah, and I would just add that, so machine learning, well, actually modern research really, right? It's just really a multidisciplinary, endeavor. So you need to have infrastructure, which, is usually not exciting. Usually don't talk about it, but it's critically important. It's like a foundation of a house, right? You need to have a good foundation of the house. You need to have people with domain knowledge, knowing what they're doing. As you are aware, machine learning is very powerful, but it's also very easily misused. So you need to have people asking reasonable questions, economically based, fundamentally, sensible questions, right? You need them to have technical competency. We don't need to invent, the next greatest machine learning algorithm. That's not really our job. But we need to be able to understand the strength and capability of each algorithm and how they may be used in a financial context. That's really important. I think also, I would probably call this part of the infrastructure or part of the ingredient that it takes to make machine learning research work in general is you need to really have a good culture. The culture comes up a lot in this podcast, but I think culture is vastly important, especially for a research organization. You need people to be very open-minded. You need people to be very direct and very honest, right? You cannot have a very hierarchical setting where, if the senior researcher says something, the junior researcher are perhaps, intimidated or afraid to voice his or her opinion. Good idea can come from anywhere, right? Nobody has a monopoly on good ideas. So we want to be able to foster that. And then, speaking as a non-Dutch, I really see that the Dutch culture, which is very flat, very direct, actually is a huge plus when it comes to research. So I really find that to be very, to really sort of be kind of a hidden edge, actually.
You say that because many of your colleagues at Robeco and with the Rotterdam head office are Dutch.
They are Dutch, yes. But, we actually have a pretty diverse team, right? As you can see, the two of us are actually not Dutch. But we do have quite a bit of Dutch, but we have a very diverse team. But I think what's really essential is that we have a lot of the Dutch culture, where it's very open, right? Everybody can voice their opinion, and nobody's really intimidated because some senior person said something, so I better not contradict. We're all very evidence based. I think that's really quite important. And again, like I said, I think it's a hidden edge that this research team has.
Just go back to a point you made at the beginning here, saying that some of these models can be misused or abused. What do you mean?
Well, machine learning, like I said earlier, it depends on what you train it with, right? Now, it's human beings that decide what you train the machines with, the data you feed into it. So if there's a hidden bias in data, the machine will learn hidden bias, right? So, for example, home loans, right? Historically, loans are given out by loan officers. Now, if a certain ethnic group historically has been prejudiced against, they're not as easily able to get home loans. If you feed the historical loan granting data into the algorithm, well, guess what? You're going to train a biased home loan machine, right?
I see. So it also comes back to the culture point that you need that human intuition, the creativity, the lateral thinking to make it work properly. How does your approach differ? Maybe, Whaley, a question for you. How does your approach differ from what you are aware of is happening elsewhere in the industry? It sounds so what you described with the architecture, the infrastructure, that there's also a degree of first mover advantage here. So perhaps you're quite early on in this phase.
Yeah, I would say infra is definitely an edge for us. I think that's also something positively surprising to Mike, who joined us lately. And apart from that, we actually are still very rigorous with the testing and also acceptance of any new innovative ideas. It's not that just because it's new, it's very novel, and the bar is lower. And we're not saying that, hey, for whatever evidence or selective bias that we see there, we would accept a model or signal into the process just because commercially it's very attractive that you have this fancy new signal. I think we really, like I just mentioned earlier on, that we really have our set of criteria, and we say that additivity, permanency risk, trading cost profitability, after cost trading profitability, all these should work, and before we give green light to something new or something innovative to get into our process. And I think also the speciality of Robeco is the joint efforts from Quant and fundamental colleagues. And that there, I think, Daniel, we have a lot of, I'll say, close conversation on what we could do together.
Yes. Another speciality at Robeco is sustainable investing. So how does this work along in that field?
Great question, actually. So, so if you know a few things about sustainable investment, maybe you know that sustainable data is hugely lacking, right? They typically have a lot of gaps. A lot of it are estimated. A lot of it comes with a huge time delay and low frequency, right? So none of these conditions are great for when it comes to investing, because you want data that's rich, that's timely, that's very frequently updated, and not estimated actual data. So sustainable investment is hugely challenged from a data front. A second difficulty with sustainable investment is that a lot of what it's trying to measure are actually it's very intangible, right? Corporate culture is a sustainable investment. Various stakeholder sentiment are sustainable investment. Whether a company is ethical or not is something that it's very difficult to quantify, right? Using traditional means. So all of these, alternative approaches, data, machine learning, algorithm, et cetera, can actually come in and help you measure various aspects of it, right? So sentiment, obviously there's using natural language processing, you can measure various stakeholder sentiment. Whether a company behaves ethically or not, well, you can actually see if they have a lot of negative news coming on, from news organizations, from NGOs, from government fines, right? Just from, do people talk badly or well about a given company on the internet? So they're just, I think the intersection of sustainable investment and alternative alpha or the alternative approaches is actually a very, very powerful intersection, and it is one of the few frontiers I really view truly relatively underexplored frontiers of investing, and I think this is just a hugely exciting area, right? As we all know, I think there's an awareness that it's not good enough just to actually make profit, right? Because we all. Listen, I mean, we live on this earth, and the resources are not infinite. We have to be able to get along with each other. So you got to figure out a way to do it, not, profitably, obviously, because not being profitable is also not sustainable. But you need to be able to consider everything. And I think all these alternate techniques just bring so much to the table, when it comes to sustainable investing.
And I think, just to chime in for the human race here, I think this is an area where...
Says the fundamental researcher.
This is an area where fundamental investing helps because, as Mike points out, the ESG data is laggy, it has a lot of gaps. And so actually Robeco has a very large sustainable investing group that actually they're looking at companies and measuring it and studying it on their own, separate from the rating agencies and the data that comes in. So I'll give you an example. We had a company in our portfolio that whose product mission really reduced greenhouse gases, but it had a really low, actually almost I think a negative ESG score, because the metrics they were looking at weren't looking at the product impact. They were looking at sort of more traditional sort of operational elements of the company, which were probably accurate, but they weren't measuring the product impact. And so our own SI team was able to sort of point that out to us. And so it's in our portfolio with a low ranking, which sort of impacts the way you might look at us from the outside in the portfolio holdings. But the actual product impact was very positive. And so you don't see that. And so I think in an area where the data is imperfect, and I think you have that a lot in structural change. And so I think the shift to a greener economy, the shift to new forms of energy is one where the data maybe wouldn't suggest that it's profitable. You look at data on people still have these sort of preconceived notions of renewable energy being loss-making, but today the actual results are it has a lower cost of production than traditional metrics, and so. But the lag between when that shows up in the market and when it's just been profits, I think doesn't show up in the ESG data.
Right. Now, listening to you on this, it's very clear that you're excited about it, putting a lot of resources, thinking, planning into this. But I have to challenge you because in preparing for this, I read a lot, watched videos, listened to podcasts. Is it realistic? Do we know for sure that machines can learn to invest and indeed create these new sources of data or uncorrelated data, that 1/3, Mike, that you said was still left on the table? Well, here's an academic paper entitled Can Machines Learn Finance published in the Journal of Investment Management 2020. And I know for sure one of the authors works for a quant firm, so he is not in some theoretical la-la land. He says the industry's collective machine learning marketing hype must be tempered. The gains are evolutionary and not revolutionary. Asset management and return prediction in particular is a small data science with low signal-to-noise ratios, making it very different from disciplines where machine learning has thrived. As a result, adapting machine learning and finance is a more difficult proposition than many commentators appreciate. So this is someone working in theory and practice highlighting this. So how much hype is there here?
Yeah, great question. I think I know who wrote that article. There's certainly a huge amount of hype, because it's sexy to talk about. Right, and just like Tesla advertised full auto driving, even though I don't think that's the case. Right, full autopilot. I think I think part of your question is, can machine be fully basically take the place of a fundamental investor from soup to nuts, conduct investment by itself? No, the answer is no at the moment. Right. Machine can help. It's like, help you break early, help you avoid blind spots, but, by maybe help you identifying certain aspect. For example, does company management express positive sentiment for next quarter's earning? But it cannot tell you whether this will, the stock you're investing will go up or down, because that, takes account so many other stuff that, much of which machine cannot yet understand. Right. So I think that's also the difference between machine learning in finance versus in other areas. Think about it, right? Machine learning in consumer. Say you buy a cookbook, from Amazon or from your favorite shopping site, right? When you buy a cookbook, it might recommend you, okay, here's a nice pan that people buy cookbook typically buys. Here's a nice set of wine glasses. Most people that buy cookbook would buy as well, right? So every time a consumer come and buy a cookbook, it will recommend this. But just because consumer is saying for consumer A, it's recommending me to buy a frying pan. When consumer B comes up, it does not lower the probability of consumer B buying a frying pan, right? So what I'm saying is that the behavior kind of stays constant in other areas. One area actually machine learning has had a huge amount of success with is imaging recognition. Right. I used to work at Google, and there used to be a joke at Google while I was there is that we spend billions of dollars, hire the smartest people in the world, thousands of them, to identify cat pictures. Mm-hmm. Right. Cat picture 10 years ago was a very difficult problem. Right. But it's difficult, but it's easy in the sense that, you look at a picture of a cat last year, you look at a picture of a cat last month, and you look at a picture of a cat today, it's not going to change. Right? Within a time frame we're talking about, a cat is a cat is a cat, right? But guess what? The market is adaptive, right? The market is it's when people start reacting the other way, market price isn't in. Market is actually, in a sense, market itself is kind of like machine learning. It's a learning out. It learns. It learns what people because market participant learns, right? So it's adaptive, meaning that the way it behaves changes over time, right? So this is one huge difference, and I agree with you. I mean, I think machine learning is somewhat overhyped, but I believe machine learning is very useful. It cannot completely do everything, so there is still roles for people, right? And but it is a very powerful tool, and it is quite evolutionary in the sense that it expands our capability in our tool sets. Before we can only look at linear relationship, now we can profitably look at nonlinear and interactive relationship. But does it answer everything or even majority of the questions you might have as an investor and you should think about? No, it doesn't.
Yeah, if I may add, actually, I think it's an excellent point, is that the market is indeed adaptive. So, for example, the earnings call transcript that we ask a machine to analyze, and then, of course, you start with a bag of words, right? Positive, extremely, great outlook, these kind of things machine learns. But guess what? All the executives, they also learn these bag of words. And then what you see is that these executives actually, knowing that the machine is at the back end, analyzing their speeches, they're changing their wording, they're changing their phrasing. And somehow the machine couldn't pick up the nuances anymore. And actually, in such a way, machine needs to adapt as well to dig deeper and to be retrained by the fundamental investor, by the quant investor, and say that, hey, now it is the new bag of words that describes the positivity and the negativity. And I think that was also a very interesting experiment we had with our fundamental team 2 years ago, that we asked man and a machine to do a competition. So we just gave the fundamental analysts, I think, 10 best recommendation and 10 worst recommendation for a machine, and asked them to rate these reports. And guess what? I think it's very interesting. On the top recommendation for a machine, analysts tend to agree. But when it comes to the negative rating, where machine was very negative, but analysts, they just see different interpretation, and they're kind of neutral to these earnings call transcripts. And this is where we see a huge divergence, and we need to have these human colleagues, right, as the trainer and the tuner of the machine, and making sure that it is doing what we would want them to do, and also making them adapting to the world that is evolving around it.
Yeah, I think that's a great point about how the executives were in that, sort of bag of words, and they were able to, sort of script their calls better, right? But I think for a long time, many people in fundamental research have sort of found the earnings call to be repetitive and sort of not providing signals. So not thinking about that question of a signal from a computational standpoint, but just from a did I learn anything new standpoint. And then you find that the same CEO speaks on a podcast 3 months later on something totally different, but he makes some comments about his worldview or where he sees the markets going, or some hobby that he has, and you're like, oh, that's interesting, and you pick up something with a strong signal in a non-structured environment that the algorithm maybe would miss because it wasn't in the earnings call.
So the human oversight remains important, Daniel. We need you.
I have to keep making the plug.
Indeed. So what would your advice be to anyone listening with their own investment firm, or even an asset owner wanting to go this route? What advice would you give them? Because there must be some learnings, but also some warnings on what the constraints are.
Yeah, I mean, I think rule 101 of machine learning is it is still a very rapidly evolving field, right? But the threshold to entry is lower, although you still need quite a few elements, right? Like domain knowledge, technical competency, data. But the threshold is lower. So I think...
But not for a boutique asset manager, right? A small manager with limited assets under management. Could they afford it?
They can do it on a limited scale, right? I think the number one recommendation I would have is just to experiment, pick it up, try it, right? I think it's really you need practice. You need to gain experience. You need to find. I would say there's no one size fits all, right, way to do machine learning. Obviously, you need to have you need to be able to program. You need to understand some basic linear algebra, right? You need to have access to some computing power. But every firm's setup is different. Obviously, being a relatively decent-sized firm such as ourselves, with management support, that we're able to build up a very robust and scalable infrastructure is a huge edge. It's huge edge, especially when it comes to maintaining and very quickly iterating, right? But even a small firm can iterate, can learn. I think really the key is get your hands dirty. Right, I think that's really number one.
And never be afraid to be late in the game. I think there's first mover advantage, but sometimes there's also second, third mover advantage, right? So you just leverage on what people has found and also leverage on what is already developed out there. So for NLP study, for example, if you started 10 years ago, it's only a bag of words you can make use of. It's dictionary, right? But nowadays, look at what Google could offer, and OpenAI, these kind of platform could empower you with the highly advanced human-like algorithm. Then that's totally a different ballgame. So first of all, I think don't be afraid to start late. And secondly, think carefully on how to buy and build. So something you can buy, something you can build, but with smaller or mid-sized company, maybe you can buy a bit more than build. Because buy, you can also say that, I start with a light investment via some experimental, like you mentioned, Mike, experimental platform, and start with some very specific cases. Like I want to try it with 1 or 2 capability. If it's in a data-driven process, how would it look like? And don't do it like overall everywhere. If you have 20 products, don't do it with 20. Maybe select 1 or 2 to experiment, and then you get a very tangible feel of how it looks and how that compares to your own experience, and then to see whether it's smart to roll out.
Right. Well, let's draw it all to a close now. What do you believe the future holds? Some CFA research said at that time, that was 2019, could be quite different now, said that at that stage, only 10% of respondents in that survey had used ML techniques over the previous 12 months. What do you expect to happen over the next 5 years?
Yeah, I think the evolution continues. It's not revolution, but evolution, right? So it's going to become more commonplace. More people are going to adapt to it. And just like quant investing 20 years ago, right? 30 years ago, when Robeco started quant investing, was probably one of the very few houses on the street in the world that did it, right? In the 90s. Now it's more common, right? But then people evolve their technique, become more advanced, and start differentiate. Everybody started doing slightly different stuff. I think it's really going to be the same way with machine learning. People are going to adopt. People are going to come up with different insights and different ways of applying, and then it's going to maybe the main ideas are same, but the changes on the margin, will cause enough of differentiation that you might still be able to extract alpha. I think it's quite exciting. I don't know when will the fully automated machine learning comes into place, right? But if Google can build machines that can beat the Go champion of the world, this is perhaps not beyond the realm of possibility. I don't know when that's going to be, but I think if that happens, it could be very exciting.
Final remarks from you, Daniel.
Yeah, I think listening to Mike talk and mention evolution, I'm reminded of the story that Steve Jobs liked to tell, where something in a study in the Journal of Nature looking at the efficiency of motion of different creatures. And so how many sort of watts would you need to propel yourself? So like a condor or a cheetah was like the most efficient, and humans were kind of, in the middle, how much energy it would take you to move, forward, say a meter or 2. But then someone had the idea to put a man on a bicycle. And that ended up being the most efficient by far. And so we're sitting here in another one. So it's
we back to the Dutch.
The bike lanes are really helpful in this regard. But he concluded that the computer for him was a bicycle for the mind. So it was this more efficient way of doing things. So in the same way that the bicycle can propel the human faster, the computer can help propel human intelligence. And so I think in that evolutionary way, AI will do the same thing for human learning.
And Whaley.
And I agree with the comments from Mike and Daniel. I think it's a facilitator. It is a bicycle for our mind, great mind. And at least we expect them to unload and unburden researchers, right, from the massive work and make us a lot more productive. And we can do more the thinking, designing work than the repetitive, for example, back test or I would say reporting work. I think that's where definitely we see it's adding the value.
Wei Li, thank you very much. Daniel, thank you. Mike, thanks to you. It was great listening to your power-packed perspectives on this topic.
Thank you, Erica.
Yeah, thank you.
Thank you, Erica.
And thank you for listening to us. Always great having you part of our conversation. We'd love to hear from you. So please let us know if you have any feedback or suggestions. You can contact us on podcast@robeco.com. And you'll find all of our podcasts on your favorite podcast platform, as well as at robeco.com.
Thanks for joining this Robeco podcast. Please tune in next time as well. Important information. This publication is intended for professional investors. The podcast was brought to you by Robeco and in the US by Robeco Institutional Asset Management US Inc., a Delaware corporation, as well as an investment advisor registered with the US Securities and Exchange Commission. Robeco Institutional Asset Management US is a wholly owned subsidiary of Oryx Corporation Europe NV, a Dutch investment management firm located in Rotterdam, the Netherlands. Robeco Institutional Asset Management BV has a license as manager of UCITS and AIFs for the Netherlands Authority for the Financial Markets in Amsterdam.